So imagine you invent a tool that makes your workforce like 90% faster.
Okay, that sounds like a massive win, right?
You think so, but then you realize your entire business model is based on billing clients for the hours those specific workers spend doing manual labor.
Oh, wow. Yeah, that is a problem.
It's a huge problem. And that is the exact paradox currently sitting on the desk of, every IT services executive in the world right now. Welcome to the deep dive.
It really is a massive structural transition we're looking at today.
Exactly. Today, we are looking at a multinational tech giant that is actively cannibalizing its own multi-billion-dollar legacy business just to survive the artificial intelligence revolution.
Right. We are analyzing Wipro, ticker symbol WIT. Specifically, we're focusing on their Q1 2027 earnings call from July 16th, 2026.
And on that call, we get the strategic vision of CEO Srinivas Pallia and the financial architecture laid out by CFO Aparna C. Iyer.
And you really hit the nail on the head regarding that core conflict earlier. I mean, they are navigating a landscape where extreme operational efficiency is starting to look a whole lot like revenue destruction.
It really is. So today we are adopting the Talk Tickers format for you. That means we're stripping away the corporate fluff to give you a data-forward, plain language, highly opinionated, and actionable analysis.
The Top Tickers format is great because we hit the 4 essential pillars, right?
Exactly. We're covering the headline numbers, the story behind those numbers, management guidance, and finally, the bottom line. Okay, let's unpack this.
Let's get straight into the headline data. Setting the foundation here, for the first quarter of fiscal year 2027, Wipro reported IT services revenue of $2.61 billion.
The growth metric attached to that revenue is where the story actually begins, right?
Yeah, exactly. Because they reported a 0.9% year-over-year growth in constant currency, but a 1.2% sequential decline.
Hold on, let's pause on that constant currency metric for a second, just to translate that Wall Street jargon into plain language for anyone listening.
Sure, yeah, it's a vital baseline.
Right. So constant currency basically just means adjusting the financials to remove exchange rate fluctuations.
Right, because you could sell the exact same volume of software licenses in Munich this year as you did last year. But if the euro depreciates against the dollar, your reported earnings look terrible.
Exactly. Constant currency strips out that foreign exchange noise so investors don't panic over things management has zero control over.
Yeah, it isolates the actual operational volume. So when they say 0.9% year-over-year growth in constant currency, they're telling us that operationally, compared to the exact same quarter last year, their global business volume is virtually flat.
Just treading water on $2.61 billion in revenue.
Right. And that 1.2% sequential decline means compared to the immediate prior quarter, so Q4 of 2026, the volume of business actually shrank.
So they're shrinking on the top line while facing some pretty severe pressure on the bottom line too.
Yeah, they really are. Net income was reported at 33.6 billion Indian rupees. That translates to an EPS, or earnings per share, of INR 3.2.
Which is a very slight increase, right?
Yeah, a microscopic 0.6% increase year over year. But the truly critical diagnostic metric here is the operating margin.
Right, the margins. Where did those land?
The IT services operating margin currently sits at 16%. That is a 1.2 percentage point drop from the previous year.
I really want to contextualize that 1.2 percentage point drop for you. Because to a casual observer, losing 1% doesn't sound like a crisis.
No, it sounds like a rounding error to most people.
Exactly. But when you are operating at a run rate of over $10 billion a year, a 1.2% slice of that pie represents tens of millions of dollars in net profit that simply evaporated compared to last year.
And it's a huge deal because management had previously established a very clear goal of maintaining operating margins in a narrow band of 17 to 17.5%.
So dropping to 16% is a glaring deviation from their own internal financial targets.
Yeah, and that creates a significant perception problem on Wall Street. But the immediate counter-narrative provided in the transcript is their order booking.
Right, the new deals.
Yeah. They reported a solid $3.4 billion total in order bookings for the quarter. And out of that total, $1.6 billion was driven purely by 13 distinct large deal transactions.
Okay, so this is the math that just doesn't immediately add up. You have a company successfully pulling in $3.4 billion in new orders, right?
Yep, $3.4 billion.
Yet their recognized revenue is stagnant, it's shrinking quarter over quarter, and their profitability is sliding backward.
It is definitely a head scratcher.
Right. So the fundamental question is, why is the profit margin slipping if they are successfully booking billions in new enterprise contracts?
Well, CFO Aparna Iyer actually confessed to what is causing this margin compression. She identified a specific trio of margin killers.
I love that term, margin killers. What were they?
She was highly explicit. The downward pressure on that 16% margin is coming from three areas. First, standard salary increases. Second, the heavily front-loaded costs of ramping up the large deals they previously won. And third, massive ongoing investments in AI.
Okay, let's break down the mechanics of those three factors. Because salary increases, that's a known commodity.
Right, inflation is sticky.
Yeah, inflation persists, the labor market for specialized tech talent is cutthroat, and you have to aggressively compensate your engineering base so they don't jump ship to TCS or Infosys.
Exactly. That comes straight out of the bottom line.
But the second factor, that costly ramp-up of large deals, that's a mechanism that frequently trips up retail investors.
Oh, completely. There's this assumption that winning a $100 million enterprise contract immediately triggers economies of scale and boosts margins.
But in the IT services sector, the exact opposite is true in the short term.
Right. You really have to look at the life cycle of enterprise IT architecture.
Give us an example of how that works.
Okay. Let's say Wipro wins a massive contract to take over the digital infrastructure and cloud migration for a global logistics company. They don't just flip a switch on day one and start collecting high-margin recurring revenue.
Right. They enter the transition phase.
Exactly. During this ramp-up, Wipro has to invest its own capital heavily. They have to hire hundreds of specialized cloud architects, secure new software licensing agreements, build out customized security protocols.
It's essentially like a mega landlord scenario.
Yeah.
Winning the contract is like buying a massive, dilapidated apartment complex.
That's a perfect analogy.
Yeah, the rent checks in year 3 will be fantastic, but right now you have to buy the plumbing, rip out the asbestos, and hire the maintenance crew out of your own pocket.
Yeah.
You are deeply cash flow negative on day 1 of that contract.
Exactly. And furthermore, during this transition, the client's legacy systems can't just go offline. The logistics company still needs to track packages while the new system is being built.
So they end up paying double.
Basically. This often involves Wipro taking on the existing IT employees of the client in a process known as rebadging. So Wipro absorbs the client's overhead before they have engineered the operational efficiencies that actually make the deal profitable.
So booking 13 large deals totaling $1.6 billion secures the revenue pipeline for 2028 and 2029. But right now, in 2026, it acts as a massive anchor on their operating margins.
Yes, they are literally funding future growth with today's profits.
But it's the third margin killer that really dominated this earnings call, right? The massive ongoing investment in artificial intelligence.
Oh, absolutely. CEO Srinivas Pallia framed this not just as a discretionary tech upgrade, but as a total structural pivot for the company.
Pallia is basically operating under the thesis that the macro demand environment for traditional IT services is definitively soft, whereas AI represents a generational structural opportunity.
Right. And because of that, Wipro has completely reoriented toward an AI-first operating model, but doing so requires immense capital expenditure.
To understand why this pivot is so aggressive, I want you to think about the psychology of the enterprise client right now. Think of client budgets like a pie.
Okay, a pie.
Over the last decade, corporate IT budgets, the pie itself, expanded reliably every year because of zero interest rate policies and cheap capital.
Everyone had money to spend.
Exactly. But today, macro uncertainty has frozen those budgets. The pie itself isn't getting bigger, but the slice labeled AI is aggressively eating into the slice labeled traditional IT.
Yes, and Pallia explicitly noted this dynamic. He pointed out that deep savings generated from cost optimization projects, situations where Wipro helps a client run their legacy servers more cheaply, are being directly reinvested by those clients into new AI capabilities.
So it's a one-to-one transfer of wealth within the client's IT budget.
Exactly. They are shifting capital from the old world to the new world.
So Wipro is essentially forced to follow the money. If the client is liquidating their legacy server maintenance budget to buy AI, Wipro must have an AI product to sell them, or they just lose the account entirely.
Right. They are cannibalizing their traditional, reliable revenue streams to fund the development of the technology that is replacing it.
And that development is not cheap.
No, it's incredibly expensive. Pallia detailed the launch of an entirely new AI-native business unit. They're constructing proprietary, industry-specific data platforms, and they're deploying a $500 million Wipro Ventures fund.
$500 million just for the venture fund.
Yes, specifically to acquire or partner with AI, data, and cybersecurity startups. All of this R&D and M&A activity is a direct drag on immediate profitability.
Let's define the specific type of AI they are building, because Pallia used several terms that we definitely need to translate for the broader investment community.
For sure.
He repeatedly emphasized their deployment of agentic AI. He talked about combining agentic intelligent orchestration for a global industrial manufacturer.
Which sounds incredibly complex.
It does. But the distinction between basic generative AI and agentic AI is essentially the difference between a search engine and an autonomous employee.
Right. Standard generative AI, like the large language models the public uses daily, is fundamentally reactive. You prompt it to write code, and it outputs code.
But agentic AI shifts that paradigm.
Exactly. It shifts from reactive generation to proactive, autonomous execution. It relies on agents. These are AI systems given a high-level objective, the ability to reason through the necessary steps to achieve that objective, and access to digital tools to execute those steps without human intervention.
So instead of asking an AI to summarize a PDF of procurement rules, an agentic AI system is actually integrated into the ERP software.
Right, it's baked into the system.
Yeah. You give it the command, audit the last 10,000 vendor invoices, cross-reference them against our customized procurement contracts, flag any pricing anomalies, and automatically draft and send dispute emails to the vendors for any overcharges.
It's doing the whole job. It's executing multi-step reasoning, utilizing software tools, and completing the workflow.
However, deploying autonomous agents at scale introduces a massive new line item to the client's IT budget, which Pallia referred to as token economics or tokenization.
Oh, the token economics. This is a huge factor.
Let's drill down into token economics, because this is where the theoretical promise of AI hits the brutal reality of corporate accounting. This intelligence is not free.
Far from it. When an enterprise interacts with a large language model, the data fed into the model and the output generated by the model are broken down into tokens.
So what exactly is a token in plain language?
A token is roughly equivalent to a piece of a word or a string of code. And the foundational model providers, companies like OpenAI, Google, or Anthropic, charge compute fees based on the volume of tokens processed.
Okay, so it's a utility model. You are basically paying for cognitive electricity by the kilowatt hour.
That's a great way to put it. Every time the AI agent thinks or processes a massive database, the meter is running.
And when a Fortune 500 company deploys these agents across tens of thousands of employees and millions of daily transactions, those token costs can become exorbitant almost overnight.
Which is exactly why Pallia noted that clients have become hyper-focused on net productivity.
Right. Enterprise CFOs are demanding a rigorous, provable linkage between the token costs they are incurring and the actual financial outcomes or labor savings they are achieving.
They're realizing that they do not need to pay for a massively expensive, state-of-the-art frontier model just to process basic internal HR queries.
They need a consultant to tell them when to use the expensive cognitive electricity and when to use the cheap cognitive electricity.
Exactly. And that is Wipro's new value proposition. They are advising clients on model routing, optimizing the balance between the necessary intelligence of the AI and the cost of the tokens.
And we're actually seeing the results of this strategy in the transcript. Pallia highlighted a healthcare client where Wipro deployed multi-agent AI systems utilizing their Wings platform to handle provider enrollment.
The metric he shared for that is almost hard to comprehend. They reduced provider enrollment processing times by up to 70%, automating 90% of the manual effort.
I mean, provider enrollment is one of the most bureaucratic, friction-heavy zones in the American healthcare system.
Oh, it's a nightmare. It involves labyrinthine credentialing processes, extensive background checks, endless paperwork just to get a doctor approved to bill an insurance network.
So to automate 90% of that manual effort, that represents a massive leap in operational efficiency for the healthcare provider.
Massive.
But, and here's where it gets really interesting. This brings us back to the ultimate paradox for Wipro as an investment.
Right.
Wipro's legacy business model is based heavily on time and materials. They bill clients for the thousands of hours their offshore teams spend doing manual data entry, basic coding, and business process outsourcing.
Yes.
If Wipro successfully deploys an AI system that instantly vaporizes 90% of the manual effort required for a task, doesn't that mean Wipro is effectively vaporizing 90% of its own billable hours?
That is the big question.
How is extreme efficiency not equal to revenue destruction? How does management justify that?
Well, this is the definitive bear thesis for the entire global IT services industry right now. The fear is that AI will make software development and manual processing so frictionless that enterprise clients simply will not need to hire massive teams of external consultants anymore.
So what's Pallia's defense?
His defense against this existential threat relies entirely on the concept of market expansion. He explicitly argued that the AI disruption is expanding the total addressable market, not shrinking it.
So he's saying there will just be new things for them to do.
Exactly. His thesis is that while the basic low-level coding and data entry jobs will absolutely be automated away, the immense complexity of actually integrating AI securely into a massive corporation creates entirely new, much higher margin service lines.
Right. You categorize these under Reimagine AI services.
Yes. First, there's AI advisory and change management. You can't simply inject an autonomous AI agent into a legacy corporate workflow. You have to fundamentally redesign the organization's processes to accommodate it.
Which requires extensive human consulting.
Exactly. And second, and perhaps most lucrative, is data priming.
Data priming. This is the unglamorous reality of the AI revolution.
Totally unglamorous. Most Fortune 500 companies have vast, decentralized lakes of messy, unstructured data.
And if you feed garbage, disorganized data into a frontier AI model, the model will confidently output garbage insights.
Right. So Wipro is pivoting to get paid for the massive data architecture projects required to clean, structure, and secure that information before the AI is even turned on.
So they are trading low-margin manual processing work for high-margin data governance and AI architecture work.
Precisely. Pallia also pointed to opportunities in model operations, navigating sovereign AI, which involves building models that comply with strict national data residency laws, and ensuring the models don't hallucinate or leak proprietary data.
And this brings us to the Anthropic partnership, which is a massive signal regarding Wipro's strategic position.
Huge signal.
They launched an applied AI center of excellence powered specifically by Anthropic. Now, there are many foundational models out there, but Anthropic is renowned for its focus on constitutional AI and rigorous enterprise safety controls.
Right. So Wipro isn't just selling AI generation. They are selling risk mitigation. They are building the safety rails for terrified corporate executives who want the efficiency of AI, but are petrified of data breaches or compliance violations.
And Pallia insists that the enterprise environment is just too chaotic for autonomous AI to operate without a safety net, right?
Yes. He stated that for complex legacy IT environments, it will always be human plus AI.
I really want to analyze that human plus AI always thesis, because it is the bedrock of Wipro's defense.
It's their entire moat.
Pallia acknowledged that if you are building a simple application from scratch, a greenfield project using modern code like Python, the AI provides staggering unsupervised productivity gains. But enterprise IT isn't greenfield.
Not at all. It is a tangled mess of legacy systems.
Right.
Imagine trying to untangle 30 years of spaghetti code written in COBOL that runs the mainframe of a major commercial bank.
I don't even want to think about it.
Right. When you unleash an AI agent into that fragile, undocumented architecture, the AI lacks the institutional context. It gets confused by the proprietary workarounds built in like 1998.
So Pallia argues that you fundamentally require human software engineers to write the complex business requirements, understand the nuances of the user stories, and ensure the AI's generated code actually functions in production without crashing the bank's entire ledger.
Yes. Wipro is betting its future on the idea that corporate technological debt is so deep and so structurally unsound that AI will never be able to fix it without a massive team of human consultants holding its hand.
The friction of deploying new technology into old infrastructure is essentially their competitive moat.
Exactly. Now, let's shift from the theoretical strategy to the actual geographical and sector performance, because the transcript reveals a massive divergence in how this strategy is actually landing.
It was a very mixed bag.
Very mixed. The numbers across different regions and industries are highly disjointed, indicating a very uneven global tech economy.
So we have to start with the areas where they're actually finding growth.
Right. The standout winner geographically was the APMEA region, that's Asia Pacific, Middle East, and Africa. That specific segment generated massive 13.5% year-over-year growth.
In Europe also showed some resilience, growing 6.0% year-over-year.
Yeah, and generating 13.5% growth in APMEA while the overall company only grew 0.9% indicates a massive concentration of successful deal execution in that specific geography.
Did management explain what drove that?
They attributed this strength in APMEA as well as the solid performance in Europe primarily to significant traction within the BFSI sector, banking, financial services, and insurance.
Okay, so they explicitly linked this to the successful ramp-up of large deals they had previously announced. So the narrative connects. Those highly expensive large deal transitions that are currently crushing their overall operating margins are finally crossing the threshold into top-line revenue generation in the Middle East and European banking sectors.
Exactly. The pipeline is maturing there. Additionally, when evaluating global industry sectors, the clear outperformer was technology and communications, which expanded by an impressive 10.8% year-over-year.
Which makes sense. That growth aligns perfectly with the macro narrative. Technology and communications companies are the early adopters.
Right. They are currently engaged in the AI arms race, spending heavily to integrate AI capabilities into their own consumer and enterprise products.
So they're utilizing Wipro's engineering bench to accelerate their own product development cycles.
Yeah. But for every region experiencing double-digit growth, there is a region in active decline.
And the Americas got hit hard.
Really hard. The most severe geographical contraction occurred in the Americas 2 segment, which declined by 7.3% year-over-year.
A 7.3% contraction in the Americas is a brutal metric for any IT services firm. The United States is traditionally the largest, most lucrative, and most vital market for enterprise tech spending.
Right. Shrinking by over 7% indicates significant structural headwinds in their most important geography.
Management attributed this contraction to the persistent macro uncertainty, right? Clients in the Americas are exhibiting extreme caution regarding discretionary spending.
Exactly. And when we examine the industry sectors driving this decline, the pain was pretty concentrated. The energy, manufacturing, and resources sector, abbreviated as EMR, decreased 8.9% year-over-year.
Largely due to softness in specific European and APMEA submarkets, though management did express optimism that recent deal wins might soon reverse that trend.
They did. However, the most concerning sector from a structural perspective is definitely healthcare.
Healthcare really requires a deep analytical dive here, because an analyst on the call specifically pressed management on this weakness.
Yeah, Wipro reported that healthcare revenue declined 2% sequentially and remains flat to negative year-over-year.
And that just defies historical logic. Healthcare has traditionally been a bulletproof growth engine for technology services, driven by an aging population and the massive modernization of electronic medical records.
It's usually incredibly steady.
Right. So why is Wipro's healthcare vertical shrinking in an era of unprecedented medical demand?
Well, Pallia provided a highly nuanced explanation of the macroeconomic realities facing the U.S. healthcare system right now.
Because Wipro possesses a massive footprint within the U.S. ecosystem, servicing both the payers, the large health insurance conglomerates, and the providers, the massive hospital networks.
Right, and he stated that this entire ecosystem is under sustained assault from severe structural and demographic forces.
Let's translate structural and demographic forces into the actual financial mechanics of a U.S. hospital for you.
Okay, lay it out.
The demographic force is the rapid aging of the baby boomer generation, which is shifting a massive percentage of the patient pool away from highly profitable private commercial insurance and onto government-funded programs like Medicare and Medicaid.
And those reimburse hospitals at significantly lower rates.
Exactly. And simultaneously, the structural forces involve relentless regulatory mandates. Compliance with the Affordable Care Act, interoperability rules, and complex billing regulations requires immense administrative overhead.
So the hospitals and insurance companies are watching their operating costs explode due to compliance and inflation, while their revenue per patient is pressured by the shift to government payers.
Their operating margins are just being squeezed aggressively.
And when a hospital network's operating margin collapses to 1 or 2%, their immediate reflexive reaction is to freeze all capital expenditures.
Starting with the IT budget.
Yes. Pallia confirmed this, noting that client budgets in the healthcare sector have been completely flat or even contracting.
The clients are under immense existential pressure to strip costs out of their systems just to remain solvent. They are not in the market to purchase experimental AI projects. They are desperate to slash their baseline operational expenses.
Pallia did attempt to reframe this crisis as a long-term opportunity, though. He argued that the severity of these cost pressures means healthcare clients ultimately have no choice but to adopt aggressive automation.
Right, pointing to the eventual necessity of automating claims processing, aggressively reducing human headcount in contact centers, utilizing AI for clinical operations.
Yeah, but the immediate actionable reality for the quarter is a 2% sequential decline as clients simply stop spending.
And the clients aren't the only ones aggressively managing their headcount to protect margins. Wipro is actively engaged in its own internal cost-cutting measures to stem the margin bleeding.
They absolutely are. The transcript revealed a highly significant metric regarding their workforce management.
What was the number?
When you exclude the impact of the employees they absorbed through the recent Mindprint acquisition, Wipro's overall organic headcount decreased by 2,500 employees sequentially.
Removing 2,500 people from the payroll in a single quarter is a massive operational adjustment.
It's huge. It clearly illustrates the tightrope the management team is walking. They are desperately trying to defend that fragile 16% operating margin by shedding legacy staff and restructuring the pyramid of employee seniority,
while simultaneously attempting to recruit highly expensive, specialized AI engineering talent.
Exactly. It is a fundamental restructuring of the company's DNA happening in real time under the scrutiny of the public markets.
So we have a company actively cannibalizing its legacy business to chase AI margins, dealing with a sluggish U.S. market but a booming tech sector. This brings us to the forward-looking aspect of the analysis, management guidance.
Right. What happens next?
Given all these massive geographic divergences and heavy investments, what is management projecting for the immediate future?
For Q2 of fiscal 2027, management provided revenue guidance in the range of $2.574 billion to $2.627 billion.
Let me translate that raw dollar range into constant currency sequential growth for you. It essentially represents a range of negative 1.5% to positive 0.5%.
And the implications of that guidance are sobering. At the absolute best case scenario, the very top end of their internal projections, they anticipate growing their revenue by 0.5% sequentially.
And at the bottom end of their guidance, they expect their business to actually contract by 1.5%.
Right. A flat to negative growth projection for a company that is supposedly at the forefront of the largest enterprise technology boom since the invention of the internet. It's a harsh reality check.
It really is. However, the top-line revenue guidance was arguably not the most critical piece of forward-looking information on the call.
No, it wasn't. The most revealing moment was management's deliberate refusal to provide a timeline for margin recovery.
This exchange highlighted a profound lack of visibility. CFO Aparna Iyer reiterated that their ultimate goal is to return operating margins to that historical narrow band of 17 to 17.5%.
But when an analyst explicitly asked how they should model that recovery, specifically asking if it would be gradual throughout the year, CEO Pallia interjected and firmly declined to provide a timeline.
He essentially told Wall Street, "I am not giving you a date."
Refusing to guide on margin recovery signals that the executive team believes the underlying variables are simply too volatile to predict.
Pallia explicitly pointed to the current volatility in the revenue situation as the primary culprits.
He noted that while they possess standard operational levers to improve margins, such as increasing automation in their own delivery centers, improving employee utilization, and optimizing their workforce, they are absolutely forced to continue investing heavily in their AI-native business units.
They are trapped in a zero-sum game of capital allocation. If they halt their investments in Anthropic partnerships and AI startups just to artificially pump up next quarter's operating margin and appease Wall Street, they risk becoming technologically obsolete in 24 months.
So they're sacrificing short-term margin for long-term survival. And Pallia tied this lack of visibility directly back to the macroeconomic environment with a very specific, carefully worded quote.
Yes, I have it right here. He characterized the macro environment as, quote, resilient, but uncertainty continues to shape decision-making.
Resilient but uncertain. That is a masterful piece of corporate phrasing.
Let's analyze what that actually means for a Wipro sales executive trying to close a $50 million contract right now.
It means the enterprise clients are not insolvent. The underlying economy is resilient, meaning the corporate treasuries have cash.
However, the uncertainty means the executives controlling that cash are terrified of making the wrong strategic bet.
As Pallia noted, enterprise technology investment has not halted, but it has become subjected to rigorous, almost paralyzing scrutiny.
The sales cycles have fundamentally elongated. A cloud migration contract that used to take 3 months to get signed now languishes in procurement for 9 months.
Because the client's CFO is demanding a guaranteed ironclad return on investment for every single dollar spent.
And because they are terrified of the unbounded token costs associated with generative AI, they are demanding that Wipro provide comprehensive, consulting-led business platforms that guarantee hard productivity gains, rather than just selling them raw technology.
This friction is exactly why management noted that some of the large deals they fully expected to close and recognize in Q1 have slipped into Q2.
The pipeline of potential business exists, but navigating the client's internal risk aversion and getting the final signature on the contract is proving exceptionally difficult.
Definitely.
All right, so we've analyzed the treading water top line numbers, the mechanics of the margin compression, the existential pivot to AI, the structural collapse of healthcare IT spending, and the flat to negative guidance. This brings us to the final pillar, the bottom line. So what does this all mean for you? If you are analyzing Wipro stock right now, how do you weigh this data?
Synthesizing the entire transcript, the clear, actionable takeaway is that Wipro is currently a classic show-me stock.
Meaning the market is not going to award them a premium valuation based on their strategic promises regarding agentic AI until those promises actually manifest as top-line revenue acceleration and margin expansion on the balance sheet.
Right. A show-me story means the narrative alone is no longer sufficient. Based on the data, the immediate outlook on top-line growth leans bearish. The negative 1.5 to positive 0.5% guidance dictates that reality.
However, there are two distinct, heavily contrasting forces at play here. You have the bear case driven by growth and execution risk, and you have a massive bull case driven purely by capital return stability.
Let's explore the bull case first, because structurally, Wipro operates as a financial fortress.
The cash generation metrics are phenomenal. Even while navigating margin compression and heavy AI investment, Wipro's operating cash flow was reported at 98% of their net income.
That 98% conversion rate is critical for investors. It means that the profits Wipro is reporting on their income statement are not the result of aggressive accounting assumptions or delayed receivables.
They are translating directly into hard cash hitting their bank accounts in real time.
And the resulting cash pile is massive. They concluded the quarter with a gross cash balance, including their investments, of $4.3 billion.
And because the underlying business generates such reliable liquidity, management is aggressively returning that capital to shareholders.
They declared an interim dividend of INR 2, but the far more impactful mechanism for shareholder return was their execution of a massive share buyback program.
Let's explain the specific financial mechanics of a share buyback for you, because it is the primary engine of the bull case here. Wipro extinguished 600 million equity shares.
Right. When a company does this, they are effectively engineering forced consolidation for the remaining shareholders.
Exactly. If you own shares of Wipro, you didn't have to buy any additional stock. But because the company used its cash to buy and destroy 600 million shares, the total pool of outstanding equity shrank.
They brought their total equity share capital down to roughly 9.9 billion shares.
Therefore, your specific percentage of ownership in the company just mathematically increased. Your claim on that $4.3 billion cash pile and your claim on all future earnings is now larger.
By artificially reducing the denominator in the earnings per share equation, they mathematically boost the EPS, even if the net income remains completely flat.
And management highlighted that when you combine the dividend with the share buyback, their total payout over the trailing 12 months returned over $3 billion directly to shareholders.
The bull case for Wipro is entirely built on this financial floor. If you are holding the stock for yield, for the dividend, and for the sheer stability of a company with $4.3 billion in the bank that actively forces equity consolidation through buybacks, your downside risk is heavily mitigated by their balance sheet.
You are essentially getting paid to wait for the AI turnaround.
But the bear case suggests you might be waiting a very long time, and the turnaround is not guaranteed.
No, it's not. The bear case focuses relentlessly on the stagnation of the core business and the massive execution risks associated with the AI pivot.
The reality is that the traditional engine of the company is currently shrinking, guiding for zero or negative growth while the broader technology sector is booming is a massive red flag.
The Americas market, historically their most vital profit center, is actively contracting.
And their margins are trapped in a vice. They are bleeding cash to pay competitive salaries. They are bleeding cash to fund the expensive transition phase of their new large deals. And they're forced to pour hundreds of millions of dollars into Anthropic partnerships and AI startups just to prevent their service offerings from becoming obsolete.
So the bearish perspective dictates that the stock will remain range-bound until Wipro can definitively prove through their quarterly earnings that their new high-margin AI advisory services are generating more absolute revenue than they are losing from the rapid deflation of their traditional time and materials IT contract.
Which they haven't done yet. Currently, they are cannibalizing their legacy business, and the AI replacements have simply not scaled fast enough to fill the resulting revenue void.
So, to summarize the entire complex landscape for you, Wipro is an AI transition story masquerading as a traditional IT services stock.
Well said.
The executive team is attempting to fundamentally rebuild the engine of the company while it is operating at full speed. For the investor, you have the safety of the massive cash parachute, the $4.3 billion reserve, and the aggressive buybacks. But you must accept the reality that the core business is sputtering as they attempt to switch over to an entirely new, unproven fuel source.
It really is a transition defined by immense internal friction and historically low forward visibility. The numbers clearly reflect a company caught between two eras of enterprise technology.
Which brings us to the end of our deep dive into the data. But before we sign off, there is a broader philosophical question embedded in this earnings call that requires some intense scrutiny.
Yes. If we connect this to the bigger picture, this raises an important question regarding Pallia's core defense of his business model.
Right. He emphatically stated that deploying AI into complex, messy legacy environments will always be human plus AI.
He is betting the entire future existence of Wipro's multi-billion-dollar consulting business on the premise that artificial intelligence will always require a human chaperone to decipher undocumented code and navigate corporate business logic.
He believes the friction of legacy IT is his permanent competitive moat. But look at the actual trajectory of these frontier models. Look at how rapidly the reasoning capabilities of systems built by Anthropic and OpenAI are compounding. What happens to Wipro's core thesis when a foundational model becomes so advanced and possesses such deep reasoning capabilities that it can untangle 30 years of undocumented COBOL code entirely on its own without requiring a team of human engineers to guide it?
That is the ultimate existential risk. What happens when the AI achieves a level of autonomy where the human chaperone is no longer a necessity, but a bottleneck?
If the entire global IT services industry is banking its financial future on clients paying them thousands of billable hours to constantly manage, upgrade, and babysit their AI deployments, are these service providers unwittingly funding and building the very tools that will eventually render their consulting-led human interventions completely obsolete?
Are they using their own balance sheets to dig their own graves?
It is the most critical question for you to monitor as this AI revolution accelerates. That is all for this deep dive. Keep analyzing the data and keep asking the hard questions.